There have been a lot of headline-worthy days in the stock market this year, so we want to take a moment to explain what it means when people say the market is up or down. Typically, when people are talking about the markets, they're either talking about the S&P 500 index or the Dow Jones Industrial Average. Let's discuss some key points regarding the two. Both indices track the price movements of their underlying components. The S&P 500 tracks the 500 largest companies publicly traded on the US stock exchanges. The Dow, on the other hand, only tracks 30 companies listed on the US stock exchanges. Companies of the Dow are considered to be leaders of their industry. Because of the types of companies included within each index, the S&P includes companies from 11 different sectors such as healthcare or information technology. The Dow only includes 9 sectors. Each index is calculated a little bit differently. The S&P 500 is calculated using market capitalization, whereas the Dow is price-weighted. The difference between the two is a topic for another time, but the key takeaway is that each stock contained within each index is not equally weighted. One stock alone could take up 5% of the S&P 500, while another could take up less than 1%. This means that significant price fluctuations in certain stocks may have a greater influence on the index performance than others. To put it into context, Amazon, Microsoft, Apple, Facebook, and Google have a combined 20% weighting in the S&P 500 as the date of this filming. So even if a large number of the companies in the S&P 500 are down, these 5 companies could prop up the index as a whole if they're doing well. As you can see, while the S&P 500 and Dow may provide some indication of how the stock market is doing, they really are only reporting on the activities of their components, not the other 3,000 plus companies listed on the US stock exchanges. I hope this video gives you a better understanding of the S&P 500 index and the Dow Jones Industrial Average. If you like this video and would like to see more content in the future, please click the subscribe button down below.